Hey, good morning once again, options traders. Well, I hear a lot of traders talking about rolling and the benefits of rolling. And no argument, rolling options is one of the most powerful techniques and benefits that you get by using options over stock. There's no way that you can roll shares of stock, but you can absolutely do it with an option, and it's a huge benefit for the right times. Unfortunately, most traders hear credit when they talk about the rolls and they assume that they are getting paid to roll the option. And that is simply not true. It leads to a lot of bad decisions and misperceptions. So, what is the cost of rolling? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, quick review of rolling for those who may not be familiar with it. It's really a technique that we use for calls and puts. And if you think of the word roll, just think of the word switch. What you're doing is switching or rolling to different strikes or expirations, or sometimes both. Now there's many types of rolls. We have a roll up, a roll down. You can roll in, you can roll out. In and out refer to time. So if you're rolling in, you're rolling to a closer dated option. If you're rolling out, you're rolling to a longer dated option. Now, most of the time when you're in a trade, at least for basic calls and puts, you're either going to roll your call options up or your put options down. And the main reason that we do that is that it's just a good form of risk management. It allows you to reduce the amount of money in the trade. And again, what we're going to do is to roll the call options up to higher strikes within the same month, and we will roll the put options down. And when you do this, it will always produce credits. And the reason we know that's true is that there's a couple of pricing principles. One says that lower strike calls are worth more money. They're more valuable than higher strikes. And that's because a lower strike call gives you the right to pay less for the shares. So it absolutely has to have a higher price tag on its head in the markets. And in a similar way, higher strike puts must be more valuable than lower strikes, again, for the same expiration. So if you roll your put options down, we know for a fact it will generate a credit. So for example, let's say that we buy the $100 call for 6, and there's our bend at the 100 strike, we paid 6. So that's the maximum loss, and we have unlimited upside gains. But now the stock moves in our favor, and it turns out that we can roll to the 105 call, let's say for a $4 credit. And when we do that, we change or switch from the red curve to the blue. Notice that the blue has been shifted higher, in this case by $4. And that's why the maximum loss used to be 6, but now it's only 2. Now, of course, there is one cost to consider, is that we shift the break-even point a little bit forward. That will be by the difference. And by the difference, I mean we have a $5 difference in strikes. If we get a $4 credit, the balance is $1. So we know that this break-even point is pushed forward by $1. It's now at 106. But we still have unlimited potential gains. And that's the part that traders are looking at. I got a $4 credit and I still have unlimited gains. Let's say the stock moves more in our favor. We roll for another $4 credit. And now we move from the blue line to the green. And again, we've shifted up another $4. But notice what happened in this case. We've gone from -2 as a maximum loss to now we've shifted the curve above 0. Now we can't even lose. We have a guaranteed $2 in our pocket, and we still have unlimited gains. Well, when it's worded that way, why not? It's as if we're just getting free money. We're getting credits from the market, and we're still staying in the position. Well, we're going to find out that's not really true, but that's the perception that most traders see with rolling calls. So it's the same idea for puts, just in the opposite direction. If you had instead purchased the 100 put and rolled to the 95 for a $4 credit, you will shift from the red to the blue. And again, the reason for doing that is you want to reduce the maximum loss. You used to be able to lose 6, that's the lowest part of this risk graph, but after the roll, we push it up here to just -2. And at a later time, if the stock continues to fall, we might be able to roll from the 95 strike to the 90 and shift from the blue to the green. And now in this case, just like with the calls, we were able to push this curve above zero to a guaranteed gain of 2. So that's the basic idea behind rolling. And unfortunately, when it's worded that way, it creates a little bit of a misperception. Traders don't really think of the true cost of the roll. And what I want you to do, the main point of this video, is to consider alternatives. So again, traders hear the word credit or things like reducing risk and staying in the position. You still have unlimited gains. What could be better? Well, the thing that I want you to consider is that you are simply reinvesting profits into a new option. Always ask yourself, what else could you do? Always ask if the new option is worth buying. See, that's the thing that traders rarely consider. They just say, oh, I'm getting a credit. Well, that's true, but you could get an even bigger credit if you didn't buy the new option. So now let's figure out what's the cost of the roll. Don't think of the word credit. Let's think of what the cost is. So for example, let's say you buy the $100 call, you spend $6. The stock now rises to a level pushing the $100 call, let's say, to a value of 15. And the 105 call is trading for 11. So yes, you could roll by selling the 100-105 vertical for a $4 credit. And that's simply because you are selling the 100 call for 15, you're buying the 105 for 11. If you sell the 100 and buy the 105, you can execute that as one trade by selling the 100-105 vertical, and that's going to generate the $4 credit. And traders look at this and go, hey, I've recouped 66% of my money, because they're saying I spent $6 and I got $4 of it back. And now my maximum loss is $2. It means I could now just lose a maximum of 33% on my money. I used to be able to lose 100%, all $6. Now it's only $2, so the worst that can happen to me is that I can lose 33%. All right, fine, but let's look at the alternatives. You could have simply closed the option for 15. And that would have been a guaranteed gain of 150%. If you spend 6 and you close it for 15, you can walk with 150%. But instead, you chose to buy the 105 call for 11. See, what you have to do is you have to learn to think separate trades. Each trade stands on its own. So let's now look at buying the $100 call for 6, and it rises to 15. You buy the 105 call for 11, and you could therefore roll for a $4 credit. That's true. And this is what traders hear. They hear the $4 credit. I'm getting paid. Well, again, let's think separate trades. What's really going on here? Well, we could look at trade number 1. You could close for a $9 profit. You spent 6, you closed for 15, that's $9 in your pocket. That's in the past, that's closed, it's a done deal. But now we could choose to take trade number 2 and buy the 105 call for $11. And so you really shouldn't say, just because I've collected 9, that the 105 only cost me $2. It didn't. It cost you 11. You spent $11. So you can see where it's a very different perception. It's not that you're getting $4 in your pocket. It's that you spent 11. You could have closed for a $9 gain. You spent 11. It was just taking those profits and rolling it into a new position. And yes, the net between those was a $4 credit, but that's not really the way to look at it. What you want to do to make the best decisions is say, do you want to buy the 105 call for 11? And if the answer is yes, then sure, go ahead and roll it. But what you don't want to do is to say, let me roll so I can capture this $4 credit and kind of get this free money. It's not. It was an $11 debit. And if you're making trades for the wrong decisions, it's never going to have good outcomes in the long run. And for anyone who'd like to learn more about the arts and science of options trading, please check out a brand new Alpha Trader course for 2023, Strategy Lab, and a brand new Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on our YouTube channel, Options A to Z's Facebook Trading Group, where you can find all of the archive videos from our trading forum. And you can find a link in the description below.